and take them away.
Morning, guys. Hope you're well. Just setting everything up. So let's have a little look and see where we're up to. Okay. That looks good. That looks good. Right. I think everything's running. Can I just have a sound and visual check, and then we'll crack on. Check. Excellent. Buddy gumdrops. Happy days. Okay. Let's see who we've got in. Yanis. Well done, my friend. Sam, Fooey, Finny. There's a shocker. Princey was in very early. Hello, Philip. SRV, that's a new one. Very welcome to you. Pete, Marius, and John Fred. Happy days. Happy days. Okay. Well, it's the end of the month. So it's open Q&A today, guys. So it's all going to be driven from what you put in the chat, etc. Now, I do have a question to start with from Mark. He can't make it this morning, or at least I don't think he can. I think he's going to be in bed a little bit. And his question is about pivots. So what we're going to do is I'll start with two questions that have been sent to me. One was from Yanis, one was from Mark, and then the rest of them are going to come from yourselves. Is that okay? Can everybody happy with that? So keep them going, and I'll keep picking up as much as I can. Okay. So what we'll do, I'll just jump in and we'll keep on going, and that'll give you time to think of something that you want to have a little chat about. Okay, so we'll start with Mark's. And the question is, right, tomorrow relating to pivot points. Is the basic idea that price action will return to the middle pivot point? Example, from an R1 down to the middle or an S1 up to the middle? Well, yes, basically. When you're looking at pivots, a pivot point is just exactly what it says it is. It's kind of the midpoint of a seesaw. And markets will automatically probe to the equilibrium, the middle. It's why moving averages work very well inside a Bollinger Band. It's the central point of the stretch. So yes, in answer to your question, if it's at R1 and you see it drifting back, its first stall point will be the pivot. Now, when we jump on charts and things like that, I'll overlay one and I'll kind of show you. But the rule of thumb with a pivot is look on a daily, and if your candle opens at 12 o'clock, as they do on IG, or if you're on sort of MT5 platform, it opens at 10 o'clock. That's the close of the day. Look to see whether it's above or below the pivot at that point, and it'll try and visit the first sort of either S1 if it's below or R1 if it's above in the initial bursts. What it does thereafter, it comes down to reading charts and making certain that your direction is correct. So the second one is from Yanis, and he dropped it into Telegram, so I had to write it down quickly. And it was based on ATR, and I think it came from the little sort of video I did the other day. Is the ATR affected by news? Definitely. When it comes to news, guys, there's only a few events of the month that can really shake the market and turn it. And it's non-farm payroll, and it's anything to do with sort of bank interest rates, the Fed announcement, Bank of England, that sort of thing. When they're coming, everything is out the window. Your levels still need to be in place, and you can still put your ATRs in, but those levels will be very weak on those days because it's going to be an acceleration, and an ATR is built on an average of the last few candles, if you like, whereas your levels are built in from historical data going back the last year, 18 months, or even further if you're going on the monthlies. So they will have a lot of weight in the market. And all you do is you wait for the announcement to come, sit out of it. I don't recommend trying to second guess the news unless you've got inside information. And the chances of that is pretty slim. But just let it do its thing and then trade the aftermath based on basic Fibonacci and your levels. And you'll find that's a lot better than the ATR. So I hope that kind of clears them. And I'll pull up the chat so I can see what you guys are talking about. And we'll kind of move it through there. Okay. So where we're up to. Andrew. If a pivot point is missed, does the price return to touch the pivot? Right. Where your pivot is... Right. Let's just pull a chart up, shall we? Okay. Pull these up. Is there any particular chart that you've seen this on, Andrew? And I'll use a chart that you've been looking at, and then we'll have a look. And just while he's having a think, I'll just drop down into Peter. Gold. Right. Okay. So we'll use spot gold. Get rid of that. Get rid of that. Clean everything off so it looks spotless. And then we'll have a look. Okay. So we'll pull out to an hour. Pull out to an hour. There we go. Right, okay. So if a pivot is missed, does the price return? Well, let's find out, shall we? So we come down to a pivot point. We'll just drop on. Now these pivots that I look at, I prefer a daily. All right. The daily just sets them in stone to have a little look. So if we look at this in the last data sample of gold, you can see it opened above here and it went straight back to R1. All right. So that kind of represents what I was trying to explain. And it's a simple trade. It's a simple idea. Okay. But if it didn't get there, what it'll do is it'll just bounce between the two. Okay. And as you can see, the S1 is slightly different to R1 because what it's doing is when a pivot is working out what's going on, it's looking at the open and closes, whether it's going long or whether it's going short, and then it's working out the average distances. Okay. And what you're seeing here, for all it's on an hourly chart, that pivot is a daily. Okay. And if I moved it up into a daily chart, it's exactly the same. But if you were using your daily chart as your trading chart, for argument's sake, move your pivot out to a weekly. So again, you can see what is happening with a weekly pivot. And again, it's come down. On this last data sample for the week, it opened above the pivot, even though it was a red candle, and it went to R1. It's a little bit like Fib. It does respect itself time and time again. Is it as strong as a Fibit? Is a pivot as strong as a Fib? No. I think Fibs are far superior. And the pivot point on a Fib is the 50%. Okay. Why? I really don't know. It's just one of those things that sort of repeats in nature all the time. And because it's well known outside of trading, shall we say, it carries that bit more weight because it's in all mathematics, whereas a pivot is based just on trading. I hope that kind of makes sense in a strange way. But basically, fibs are far superior. Okay. So, oh, Ivan's here. You've got to be careful with Ivan because he's the mad axe man. And I've got a bone to pick with you, actually, Ivan, because you've got my missus wanting to go to the axe house and throw axes about. Now, I'm not sure whether she's actually going to throw them at the board or whether she's going to throw them at me. But you gave her the idea. But no, it was great to see that, actually, Ivan. It was excellent. Oh, he's there. Mark, I answered your question, but you'll be able to catch it in the replay. Okay. And I picked up on the daily and the gold for Andrew. Fibbit. Fibbit from the Hobbit. Fibbit the Hobbit. That's what we'll call it. You can put your fibs in as well. And what you'll find, Yanis, is everything that you do is just a little bit extra tool. And one of the things that you hear me say over and over again is less is more. Don't cloud your charts up with loads of indicators, loads of pivots, everything. Put your levels on. They are perfect. They'll show you where the chart's been and they'll give you a good idea where it's going. So that's the first thing. A Bollinger Band is very simple. It shows very little real estate on the chart, you know, because you can just have 3 lines if you want. And that saves you putting on a moving average because it has a moving average. And then one indicator below. Because the one thing you want to be paying attention to more than anything, and this is something I genuinely try to get across, if I move this off, you're now looking at the best indicator there is. It's the price itself. So many people put so much weight on indicators, the magical fib, this combination with this and this, but they don't actually look at the price itself. And if a price is chucking to the upper side and it is past a midpoint between 2 levels, is it not a fair idea that this thing is going to continue to truck and the stall point is going to be the next level? That is far more powerful than trying to work out moving average crosses, etc. And when I touch on moving average crosses, because I was talking to Rory earlier on in the Discord, and he was asking about courses and one thing and another. A lot of them are these repackaged moving average courses. You know, say, oh, well, when the 5 passes the 200, you go in and you hold it till it comes back. Yeah, it does work. But only so many times throughout the year. And that's because they're based on daily and weekly charts. They're fantastic. But they then sort of try and push it down the pipeline onto a 5-minute chart. And you go, oh, well, you're getting in. You get, but they don't. Because by the time the cross has come, the move is finished and it'll just cut you to shreds. So you've got to be a little bit careful. And that's why I say keep your charts as clean as possible. So not to worry. So let's have a look, see where we're up to. Stops me going down the rabbit hole. That's the thing, Pete. You can go way down the rabbit hole. And one of the worst things you can do is find, well, I call it shiny bollocks syndrome. Because that's what you do, and you're just looking for the next shiny bollocks. You know, oh, this is great. And then suddenly, oh no, that one's great. And then this one's great. They're not. They all work, but you've got to let them breathe. In other words, you've got to ride out the rough with the smooth, you know. Doesn't matter what you're doing, you're going to lose. All right, I'm on a good streak at the moment, but I know I'm going to get a smack in the teeth before long. But will I change what I do the day after I get smacked? No. I'll do exactly the same thing again because I know it's battle tested. And I hope that sort of sinks in a little bit. So is that a new technical term there, Scruff? Yeah, we'll call it a fibot. No one will know what I'm talking about on the videos when I start saying, yeah, we're going to put a fibot on. Actually, that's a good thing, really. Keep Popeye out the way. Let him bloody burst the blood vessel. All right, not to worry. Where are we up to? Right, so keep the questions coming, guys, and I'll keep working my way through because it's like a 20-second delay or so. Now, let's have a look down here. So Yanis says the only course you need is experience. You know something? That's probably the wisest words that you're ever going to hear. You know, so a wise head on young shoulders. Because whatever you do in life, you're not very good at it when you first start. But if you have experience and you practice, then you become good. It doesn't matter what you do. You ride a bike for the first time. Did you get the pedals going, hold the balance, off you go? No. You know, I've got a bloody broken elbow. I've got cracking scars here from falling off bikes and all sorts. Here I am, 52-year-old. I can jump on a bike and ride it. Why? Because I learned. Experience. When I was 6 and 7 and 8 and or however it was old I was learning to ride, didn't have any experience, fell off. So let's have a look. Steph. He's ended up with the Bollinger Band, RSI, MACD, Fib, pivot on an hourly. No. Well, I'll tell you what, Steph. What was the last chart that you traded? And we'll pull it up. None? Maybe? Who knows? Let's find out. Or do you want me to pick you one? FTSE. Right, okay. FTSE. All right. We don't look at the FTSE much, so that's a good market. So we'll claim this down as well. And then I'll remark it for you guys a bit later on. Get rid of this. We'll put it onto the normal. Right, I'll get rid of all the marks. And we'll build this up. So we like an hourly chart. That's what we do when the computer doesn't freeze up. So let's see, what have you got on this? So you've got a Bollinger Band on it. So you've got a Bollinger Band. And you have an RSI. RSI. And we have a MACD. Okay. What else have we got? Got a pivot as well. Okay. Got a pivot. And a fib. All right. Well, I'm not sure where the fib is, but what we'll do is we'll just draw it on this for argument's sake. Okay. Right. So that is potentially under 8 AMA. Right, okay. So without putting any levels on, that is what your chart looks like. So you tell me, do you think that is too much? Curious. I mean, don't take the mick out of him, guys, but just a yes or a no will suffice. Yes? No? No. All right. No. All right. Just saying what the thing's in. So we've got like kind of a mixed bag between no and yes. All right. Kind of split down the middle. I would sit bang in the middle because it depends on how you read this chart. What I would suggest, and it's kind of the way that I look at things, is strip it off once you've used the part that you need. Okay, so to give an example, I'll mark it up if you want me to mark it up. But the first thing I'd be doing is looking at the marks of where I want the chart to be. Okay, so if you can imagine, it's got its S&R lines already in place, and I'm coming into this chart and I have all of this. All right, start filtering down the process of what you're looking at. So an anchor chart for the FTSE is the 1 hour. So you're on the right chart. So what's the first thing you do when you're looking at the sample of data? Well, you want to see what the 8 is doing. Yes, we are trading above it. Great. So I can now remove that because I know where the price is in relation to it. It's above. All right. Now, the next part of it is, where is the pivots? Where is the fibs? Okay. Well, the fibs is very simple. You look for the last drive. Well, it was here. Okay. So where do we want off this? Well, you want the key points. So if we drop in the 23, 38, and the 50, but we can see it's trading above this last range. So I want to see where the expansion is above. So I get that from there to there. Pull that down into this. This will then give me my expansion points, where store that perfectly. And then I'm looking at the full expansion to the 161. Okay. So I can now get rid of the fib. All right. I can see that we are running to the outer side of a Bollinger Band. So I'm looking for snapbacks. All right. I'm either looking for a snapback or I'm looking for a continuation, depending on what these two are about to tell me. Okay. So what I'll be doing now is looking at the pivot. So I can mark a pivot in. All right. Okay. This is if I so wish. I don't normally do this personally myself, but I'm doing this as if it was you, Steph, to help you sort of clean things up. All right. And then I want the pivot there. All right. I only need these because I'm working on the upper side at the moment, so I can get rid of the pivot. Now I need to figure out whether or not the market is moving up or it's going down, or I'm going to wait. Well, if I change my settings on the MACD into fib settings that I like to use, go up +1 so I can get an overall view. Well, that is going up. So we'll just drop an arrow on so that I don't forget. So that is one arrow going up. It is still moving up. So that's 2 arrows moving up. All right. Write this down on a piece of paper or something like that. Let's have a look. 15. Well, the 15 is kind of neutral, so there's nothing going on here, flat. All right, and if I want to really zoom in, take it into a 5, and that is pushing down over. Okay, so go back to my hour. So I've got 2 up, 1 flat, 1 down. I also know that this is pushing on the outside of a Bollinger Band. when it pushes on the outside of a Bollinger Band, it's going to come back on itself. We know this. So the fact that the two MACDs that are 15 and 5 are flat and down tells me that snap might be coming. So I don't need these anymore. So what I've done now is I've put in my mind that I'm looking to go short. Why? Because the MACD is telling me that, the Bollinger Band is telling me that. All right. So do I need this anymore? No, I can clean that off as well, just so I can see where I'm going. What else can I look at to see if there's a snap due? Well, we're going to remove the MACD, and then I'm just going to look at the RSI. I can already see that it's oversold here. So that again is telling me a snap is on the horizon. Drop this into the 1 hour, onto the 5/80/20. Again, it's telling me it's oversold. So this is telling me the snap's due on the hourly. That's telling me the snap's due on the 4. This is telling me it's starting. Okay. And then let's have a look at the 5. Again, it's starting. It's meandering back up, so I don't even need that anymore. So if I'm looking to trade this based on, I've got levels off that fib. We have this one running up. That now gives me an entry zone here, which is based on expansion and a pivot. And I can run the price into there to look for it to roll over, or I can use the break of this looking for it to come down. So what I've essentially done is I've looked at the same amount of information that you are, Step, but I've systematically stripped it out once I've finished with it. Now I can trade a clean chart, and I can monitor it depending on what your trading chart is, if you like a 15-minute or a 5, on something like this. Nice and simple. And if I was going to expand on this, I can also use these levels that I've put in using a like the Fibonacci golden eye principle. Put that on into the top of this zone, which is up there, and it can start giving me pictures to work with. So there's a bus stop that you can work with, and there's also another one directly above it, which is here, just like so. So from that simple move that you saw further back in the chart, we've mapped the chart. So you not only have you mapped the chart, you've cleaned the chart, and you've used the same indicators to give you an idea of what you're up to, and now you wait. Is that not a cleaner way to look at it rather than leave everything on the chart? That's kind of the way I would do it anyway. Okay, let's have a look, see what else we've got. Okay, so right, so let's see. So it's all the yeses, nos, and then Mark. Oh, you woke up. Well done, son. Question on fib numbers. Once they are below 0 point at the range you drew, are the levels below? Is it a case that not necessarily? As you've just seen in this example, when I was sort of breaking this chart and working it out, if I move this back out to the hour, what I was looking at essentially was a strong drive of a fib, all right, without using any support and resistance levels. And what I saw was this. So you can see it's a strong drive down, the consolidation. There is the hammer explaining that this is going to burst to the upper side, because that's what happens. It moves down, It'll shorthand and then off it goes. All right. So that will be the first part of the fib, and then we can clearly see the top part of the fib, and it's come down to roughly 50%. So that locks that leg of the chart in stone. Right? Now you can argue and say, well, why haven't you used this if you know there's a snap coming? It's because I don't know that's finished. All right? That could easily, as I've just explained, get up into this level here. And when it does, and then it recedes, then I'll be able to use this. But at the moment, I have to use an echo of the past to give me a vision of the future. And that's what this is. All right. So if I draw that fib back on, and I just put in the retracement that you can see, which are the kind of the blue lines, slightly off, but you can see the point. There is the move. It came down into the 23, and as I keep telling you, it'll go and it'll bounce the 50 almost to the, well, it did go to the pip there, tested a couple of times, and then it was off. But where did it stall at each of its journey path up here? Where it stalled again at the 38 and the 23. So as long as the price is between the 2 points, those levels kind of stay relevant to what's going on. But then also there is expansion points, and the expansion points also stay in stone until a new fib is formed. Now at the moment there isn't a new fib being formed because there's been no retracement back on itself here. So if I expand this up into the direction, which is here to here, and it doesn't matter what chart you're on, guys, the principle works because it's math based rather than sort of product based. Again, there's the expansion points that I drew in, and you'll be astounded how many times these get respected as well, because there is the 127, and look at the stall. It is almost to the pip, and that's why this becomes very, very interesting. Now the markets will never be pip perfect, guys. You know, they'll get to there or thereabouts. So as you can see, it's gone to the 127, it poked above, came back, but look, to the pip, to the pip, to the pip. And that's why I draw zones in, because the zone represents an area of interest, an area that I know the price is probably going to probe. So anything in and around that is perfect, you know. And it's why I like GoldenEye, because when it breaks out of the zone, it's a high probability it's going to the next zone, zone to zone trading, but it's all from mapped out fully. So that's kind of the relevance. So this will stay in place till this is run out of steam, and it'll just keep on running all the way up, and you see it over and over. Now you can even do it on a micro scale where you can use just a single candle that is overextended, and the maths work out roughly the same, and I'll show you. So I'll just kind of get rid of this. This is what's deemed an overextended candle, this one here. And an overextended candle is just something that is out of the ordinary, something that it just sticks out like a sore thumb. So it's kind of why non-farm payroll works. So we can see it went there, it got up as high as there, and then straight across, it's come straight into the 50, and then there it is, the 161, just on a single candle is represented right through. All right, but you need something that is excessive. You know, if it's not excessive, just like a normal candle like this, it works, but it's so small, it's neither use nor ornament. So you need some data within it. But what you're better off doing is seeing something like that. Then it becomes valid, I guess, because there's so much data in there. It gives the maths time to work out. All right. So I hope that helps. So let's have a look, see where we're up to. So that's marks. Yeah, always have your levels on. I stripped them off this simply because I wanted the chart to look clean, but those levels that you put on, and it's always the same three. Okay, occasionally look at 4 hour, but even then it's a rarity for me. But it's always monthly, weekly, daily. If you've got those levels on and you've drawn them properly, and the way it works, because I have noticed there's a couple of newer guys in here that I haven't recognized the name. You want to be looking at a monthly is as far back as you need to go to get a level above and below the price, but the ideal time scale is around 18 months. When you come down onto your weekly, you want about a year's data roughly, and then once you've put in your weekly levels, you look at a daily at about 3 months worth of data. And what you've done is you're siphoning down into what's called the here and now, what's happening today. And that's the best way. But if you go through some of the other live streams and plenty of the markups, you'll see how it's marked. And when we do another sort of session, when we going more strategy specific and more chart specific, you'll see it getting drawn up in real time. Okay, so let's have a look, see where we are. So that's that. So Yanis, first levels, oscillator, RSI, fib, and some, yeah. Now, I can look at a chart without sort of MACDs on it because I can just kind of see. I've just been around the charts that long. I can almost just, it's like the Matrix. I can just kind of see it. But the MACD is perfect for helping you gauge your direction. And as you saw in this example when I was doing this, don't rely on a single chart. Go one up, one below, and then a trading chart as well if you so wish. And if you are going across the 4 spectrums, and that's like 4 hour into an hour, into a 15 for confirmation, and then an entry on a 5, check the MACD across all of them, and then score it. Sort of right, it's going up on the 4, it's going up on the hourly, it's going up on the 15 minute. Well, it's a fair bet the 5 is going to catch up eventually. You've got a bias, but you need to have read it into the charts as well and understand what was going on. A little bit like what I was doing with this footsie chart about looking for the snap. You know, for all the 2 points on the 4 and the hour were pointing up, everything else said it was going the other way. So what that does is it actually gives you an idea of where you're going to map to. So if you're short, you either want to be selling high or selling the continuation, and likewise with vice versa if it's going long. So if it's going to be high, it's going to be here. You know, if it's the continuation, it's the break of here. And if you've got that planned in your mind, then you just wait for it. Simple stuff. And trust me, waiting will make you more money than anything. You know, you guys have just seen me do 20 grand in, let's see, I started on the 12th and it hit 20 grand on Friday. And that was waiting. I never chased the market, did that principle. And my position sizes weren't that big. And that was it. It's just patience. Always wait. You're better off waiting all day for one trade than trying to force 5 substandard trades. You'll earn a lot more. Okay, so let's have a look, see where we're up to. So SRV, thoughts on best parts for an Australian guy, Perth. So front. So, well, what I've been doing, guys, and actually if you connect with Mark and Ivan for that matter, Those guys trade sort of the Asian session a lot, and I have stayed up late for them. Now, the rule of thumb when you're trading your asset is you want the banks to be open as well. So if you're in Australia, you definitely want to be having AUD in your pair. Ideally, something else that's open roughly the same time. So the Kiwi, New Zealand dollar, JPY, they're very good. You've got world drivers that you can use. Gold operates 24 hours a day worldwide. Don't matter, because every nation buys it or sells it, that matter. Likewise with oil. So some commodities are pretty darn good as well. But for Mark, I traded this week the Aussie JPY, and it's a good pair for that time of night. What you got to remember is, though, between sort of 10 and 11, and this is my time, so you'll have to put the calculations in for your clock, the spreads widen up. But 11 p.m, when the banks reopen after the close session, they nip right in. So as a word to the wise, if you're looking for a single trade per day, your spread wants to be less than 3. Anything more than 3, because it's a slow time of the night, it gets a little bit harder to time the market right, because if you're wrong, it's got a long way to go before it gets you into profit. It's not so bad in the London session because it whips about and the retracement in sort of 3 pips in a heartbeat, but at night it takes a little bit of time. So just be careful of the spread as well, SR. So Pete, interesting. I would have said wait for the pullback and go along for the next hour. Why? You'd be waiting a long time, because what you got to remember is this is an hourly chart and everything is stretching out. So that, even getting up to there, could take it a good couple of hours. If I was waiting for a pullback to go up to there, it might even be the next day. So sometimes you got to just trade the conditions that you see, but trade them sensibly. There's nothing wrong with your thought process, but you've also got to look at what everything was telling you. The fast time was telling you it's coming down. The Bollinger was telling you it was at a stretch point, and the RSI is telling you at a stretch point. And this is actually quite a decent move. So even if it did sort of continue down, and let's have a look. Let's get a measuring tool. So there you go. So that's thick end of 40 pips you'd have to sit through. Now the ATR on FTSE is about 80, 70 to 80, so that's half a day you'd have to wait, rather than looking for the next hour. So that might actually drag you in early, and then you're going to have to sit through 2 or 3 hours of pain to then get back up. Hope that makes sense. So happy days, happy days. Good stuff. Fibs, Mark, are, I would call it the ultimate tool, because if you've got nothing else on the chart, at least it can give you a framework. Now, can you use them on their own? Of course you can't. There's nothing can be used on their own. You've got to build up some kind of it's almost like a detective. You've got to put all the clues together and form a picture, and then all you do is you eliminate everything that is not right, and whatever's left, no matter how improbable, has to be correct. And that's kind of the way I look at things, you know, Star Trek analogy, if you like. And let's see if anybody knows which one that was from, because, well, it's actually from Agatha Christie, but it was brought up in Star Trek. See if anybody knows it. And I'll tell you a little bit later, because it's been in my mind a little bit this week. So there we go. So, but yeah, and that's it, Steph. It's just building a picture and trying to formulate that idea. So good stuff. Right. Is it worth investing in TradingView or ID charts adequate? I'm not rightly sure, Fred, because I don't use TradingView at all. Not really. I understand it now. I work my way around it, but I like IG charts. I like these very much, but I've used them for years. And what I would also do is I like MT5. I've never got away with MT4 for some reason, but MT5 I find it quite easy and intuitive. But I think Finney uses TradingView. There is a link in the Discord that'll get you into it if you're interested. But I like IG. I find them. I love charting on this because I find it very clean. I find it very easy. Okay. So he's on clean and duty. Ah, dear me. So much for being man of the house. And you have a good one, Yanis. I'll catch up with you soon. Okay. Steve-O. Okay, so we know who you are. Okay, Steve-O. Does that mean you're a bit of a jackass? Not that I'm insulting you, it's just that's the first thing that comes into my mind. Steve-O and all of them idiots that used to jump around and hurt themselves horrifically, and I used to laugh my cotton socks off at it. I used to think it was hilarious. A lunatic. Happy days, but anytime, kid, anytime. Okay. Yeah, I think actually when you're learning, I think until you actually know what it is and understand it, that is the natural knee-jerk reaction. Oh, that's just bollocks, you know. And to me, a lot of them, I think that of other things as well. When I see people talking about order flow and you need to know where the buyers and sellers are, to me it's just bollocks, you know, because all they are is just, it's price at levels and it just looks pretty on a picture where it's bouncing around all over the place. But my brain doesn't run fast enough to keep up with those orders going in and out. It really doesn't. So to me, that's nonsense. But then somebody else will go, oh, well, this is perfect. You can see there's more sellers here. Well, that says knock off, because in the next hour, that could completely change. It's horses for courses, I guess. So let's have a look. How would you read the last day candle on WTI? Confused me when the long... All right. Exactly the same way. So if we pull up oil, daily, right, so there is your daily candle, right? Now if it has the massive wick as you are talking about, what's to be confused about it? To me, looking at this on a daily, it's telling you there's downward pressure, even though it's a green candle. Green candle, downward pressure. How do I know that? Because I can see it, right? But I can also see it here, you know, looking at the market itself. So there's reasonable. It's had a try to pull back. It's pushed down. It's pulling up, and then it's coming down. So that could be just a consolidation. So the first thing I would be doing here while I'm building things up is put in daddy levels. Now, if I widen this out, you should be able to see it as it goes in. Okay. So a daddy level is very simple. You have a level at the top, make these solid, just so you can see them, and you have a level at the bottom. So straight away, without doing anything else, you have a trading range. You can see where this thing is been, and it is locked. Okay. We now need to know where the open and close is to tighten up price structure. So you've got these levels here. We'll change these colors just to blue, and so we can recognize them different. So again, we've now tightened the range into where the price is now. So what else can we look at this? Well, there's another area of attraction within this, because it's all well and good saying, well, I know where the high, the low, the open, the close is, but there's a fifth piece of information, and it's actually the central point of that, which is here. Okay, so that can give you something to work within moving forward for the next working day, because we know price revisits where it's been. You know, it looks for the high, the low. It'll try and find open and close points, because they are where the money was at the time, and then fib and going back to pivot points and everything like that is a central point. So the actual pivot of that day is here. So that can help you break down a candle, you know, very, very simply. Works quite often, you know. Case in point, I'll tell you what, we'll clean this off and we'll drop in some levels. So put that there, that on the top of there, put in that one, and then we'll look and see what the makeup of this is on the next day. And then we want the measuring tool there through to there. There's a midpoint. Get rid of that. Okay. So what day was that? That was the 29th. So we'll drop that down to there. So that candle would have opened that hour. All right, where's that? That one. There. Right. So there is the candle from the day before broken down into simple levels. High, low, open, close, and a midpoint. Well, what happened? Well, it opened here. Bang. Straight onto the level. This level is held. Where's it gone? Well, it's gone straight up to that one. But look at the testing points. The midpoint. The pivot. And then it burst out. But then it's come back. Where did it stall? Bang on the level from the previous day, because that's where data and value was, and then stalled bang on the midpoint. So when you start breaking down things simply, you can start road mapping where this is going to go. So again, if you're looking at price itself, well, if it isn't breaking this and it moves up and it breaches the top of the previous red candle here, there's an order, there's your first take profit. That is a good trade. And then likewise and likewise. So you can use the same principles as what you see all the time. Pockets of air, moving from one level to the next, and just being conservative with what you're doing. Even just breaking a single day candle can make you money. Does that make sense? Are you happy with that? So, and you can't say these are cherry-picked charts because you picked them. So where are we up to? How are we doing? Yeah? Everybody happy? Okay. So is there anything else? Well, more pearls of wisdom. I wouldn't call them pearls of wisdom. It's just, well, maybe that. It's keep it simple, guys, is all I'm saying. There's no magic system out there. There genuinely isn't. And if there is, it's called patience. The problem with trading is always the same. It's trying to rush the process. And if you can calm that down, you'll do so much better. Like I say, I mean, there's an interview with me, as I was alluding to earlier on, with Desire to Trade. I think it's out today, if not tomorrow. And I do touch on that sort of principle within it. So it served me well for years, and I just hope I can pass that over to you and stop you over trading. And if I can do that with just one of you, I've probably done a good job. So is there any other questions? Are we good? Are we done? Because we've been banging on about an hour. Yes? No? Happy days. Okay. All right, guys. So we'll wind it up. There'll be a replay on this afternoon sometime. I'll be at it again probably, well, certainly before 9 tomorrow morning. I'll be at the chart. Again, well, actually, as a final pointer, I'll go through that, actually. Never be in, like I say, patience. Never be in a hurry to trade. Now, Monday through Friday are my trading days. I don't like to trade Monday morning because I like to see what's going on. And the reason being is it's unpredictable. And if it's unpredictable, I don't like it. So I stay away from it. It's why I'm quiet on a Monday morning, because all I'm doing is watching what's going on and just sort of making certain my charts are ready. You know, simple stuff, just finishing off from the weekend. And I do the same thing on a Friday afternoon. It becomes unpredictable, but the market starts slowing down as well. All right, it was a bit naughty on Friday where I did a few extra trades on gold, but I was so close to 20 grand. My ego, which was a bad thing, took over because I was getting goaded a little bit about not hitting the 20k, and I thought, well, sod you, I'm going to do it anyway. So I went in and did it, but it's not something I would recommend. So Monday afternoon to Friday dinner time is perfect times to trade, and then outside of those times, don't trade at all. Prepare the markets and just enjoy a good life, and it'll make you so much happier. So there you go. So that's my little end. And just since nobody got the right answer, if you go and watch Star Trek 6, The Undiscovered Country, you will find that analogy. And it's simply because David Warner passed away this week, and he was such a great actor, and he was in Star Trek quite a bit. Such a guy. So there you go. Catch you all soon.